Tactive's mission is to provide access and financial independence through evolving technology. And with me is the CEO of Tactive, Joe Gissy, and also a family Office Insights CEO, Arthur Bavalis, who's looking at Tactive as an investment and kind of been involved with the company in the community.
Okay. And we have friends in common, so that's also
okay, great. So let's start with just what Tactive is all about, because you're in wealth advising, but again, in kind of a different way. So explain how the company works.
Yeah, I mean, the traditional way is that we are considered a TAMP, or Turnkey Asset Management Platform, which helps the transition of advisors and wealth managers from their bigger broker-dealers, bigger RIA firms. When they want to become independent, they need somewhere to go, and they need that back office support, and they need strategies and everything that comes with all of a sudden being your own business owner. So we provide that in the traditional sense. But we have a competitive edge because we have a WealthTech platform, which is our robo, which is a little different than the robos that have been on the traditional market today.
Okay, so I want to talk about that because I had talked to some robo-advisors a few years ago, and I remember they were kind of geared toward you're right out of college, and you're young, you don't have a lot of money, and your mix of investments is pretty typical, a lot of stocks and things. So how are you different?
Yeah, so originally we created Tactive because I wasn't really happy with the robos that were on the market. I was dealing with people that were hitting retirement, and they needed something that could help them get into investing a little easier, but also have strategies that work. And on the market, the robos were pretty much doing the exact same as your typical no-load index fund. Right. They weren't really beating the market, and then when the markets tanked, they were tanking along with the market. So what we wanted to do was create a robo that had tactical strategies, thus the name Tactive. So something that was a little more active, dynamic, minimizes risk, minimizes the drawdown, and helps a portfolio out. And it could work for somebody who has high net worth. And we wanted to make it, tech enough so somebody who is getting into investing, they can get into investing with a solution that could start them on the right path.
Yeah, and you mentioned the drawdown. So explain what that is and how do you work around that?
Yeah, so drawdown is basically, from when the market had its peak to when the market hits the bottom. So pre-COVID, and then all of a sudden the bottom of COVID, and then, we slingshot back up. So what is that actual loss in a portfolio? And if you can minimize that loss, so if you have a tactical strategy, let's say you get out half of that time, even 50% of the time, and you don't lose as much as the market, and you're sitting out, maybe you're sitting in an alternative asset class, maybe you're in cash, whatever that might be, but at least you minimize that loss. When the markets rebound, you gain a lot more that year, and you've made more money, but you've also saved more money. So it's managing risk.
Okay, and I want to talk to you a little bit more about that, but let's bring Arthur in real quick. So, Arthur,
we actually had a conversation about this when Joe did a Family Office Insights webinar just a few weeks ago, because even though I'm a poor writer, I wrote this thing that actually makes sense, and Joe commented on it, is that if you lose 10%, it doesn't take 10% to get back to even.
That's right.
Right?
Yeah.
And so even though that math is pretty clear and known, people don't think about it that way. So, you have to have 11.72% to get back to even, or whatever the number is, right? So if you can minimize the downside, which is what the traditional hedge has been all about, then you can make it so the time to recovery is less.
Yeah.
And the rate of return is less, right? Yeah. To get back to that. One of the things I wanted to ask you, Joe, is that a lot of people have created their careers on the back of big wirehouses, and there's value in that. You have a brand, they do all the research, you have analysts and all that kind of stuff. And why do people generally want to leave that environment and go independent?
Yeah, you're trapped in a box. So you only have these solutions that the wirehouse is going to give you, and you don't really have full financial independence. So if you are trying to find other asset classes that fits your customer needs and you can't because you're told you can't, and a lot of times they're stuck in those boxes because that's the way the companies make money, and that's just the way the finance business works, right? But once you're independent, you have this whole world of options to you, and you can really do what's best for the client. And so we want to help support that for our wealth advisors and the people that do come to us, is give them that true independence, save them some costs, so that way they can be more profitable on their own.
I was going to ask about that. So it seems like with the technology, you're able to reduce fees, which can be significant.
Oh, absolutely.
Yeah.
I mean, you're giving away, and I won't name any of the big names out there, but I know sometimes you're only making 40, maybe 50% of all the fees that are being charged to your client. And what type of support are you really getting for that? And are you really getting the options you need? And so we're trying to provide really unique strategies that you can't find at other places with our strategists.
And then, Arthur, what was it about this company that you see a lot of companies? What was it about it that piqued your interest or made you think it was a promising candidate?
There are often companies that come to us through friends that just we don't like. And in this case, they came through friends and we liked it.
Okay.
And so part of, and the reason why I put that caveat is that if we didn't like it, then we wouldn't be here, right?
Right.
So, but in this case, I have not only some background in investing myself, but I also historically been involved in distribution of financial products years and years ago through some actually public companies right now. And so I understand the sentiment of somebody being with a big wirehouse and then going interdependent, and then all of a sudden all of the things they have to do that were otherwise taken care of by the back office, and they're giving up 50% of their gross income to get that done. And once you establish a client base, then you can serve them better by being independent because now you have scale. So I'm not saying that big wirehouses are bad. I'm just saying that if you want to shift and not only have more income, but serve your clients better, arguably, as long as you're good at what you're doing, then there's a massive trend towards that. And that's part of what Joe is doing with the firm. And then having investment options that are conducive to providing that benefit to the clients, because it could just be all garbage, but it's not.
Right, that's true. Yeah. And you're looking to raise money?
We are. We're on a raise right now. So we're in our first raise. We're raising $10 million. We're actually giving away about 20% of the company. It's like just like you see on Shark Tank, right? Only a little higher evaluation, a little higher dollar amount. But we are, and we've done a pretty good portion thus far. We're a profitable company already. So we have over $100 million in assets that we already manage in less than 5 months. We're already past the $1 million mark on gross annual revenue. So we're doing well for a company that basically just kind of popped up, even though it's been a long work in progress.
Yeah.
But according to how everybody sees it, they think we just opened the doors 6 months ago, 5 months ago.
Yeah.
So we're doing well right now.
An overnight success that takes years. Yeah.
Right, exactly. Yeah, it's been a long time in the making.
Okay. Well, best of luck. Thank you so much, Joe and Arthur, for joining me.
You're very welcome.
Thank you.
Thank you, Jane.